Now you learn about accounting principles. The real purpose of accounting is to provide information that is useful to users of the financial statements. Who are these users? Depending on your business, it could be yourself, the owner, investors in the business, the IRS, and others. What kind of information is useful to users? The answer is information that influences decisions they make about your business. However, with all these different users of the financial statements, determining which information has decision usefulness is a complex question. That's why accountants developed accounting principles. These 6 principles provide guidance on whether accounting information is useful to users. Next, you learn about these 6 accounting principles. Then, I'll be back to explain the relationship between these 6 principles and the actual accounting rules.
In this topic, you begin learning about the 6 accounting principles. These accounting principles identify if accounting information has decision usefulness. The first principle is reporting. This principle states that financial reports must show information that is useful to a user. The second principle is reliability. This explains the characteristics of accounting information that make it reliable. The next principle is comparability, making sure accounting information is consistent from one period to the next. The fourth principle is cost. This explains that you record accounting transactions at cost. The fifth principle is the revenue principle. This defines revenue, how to measure revenue, and when to record it. The last principle is the matching principle. This provides guidance on matching revenue with the associated costs. These principles fall into 2 general categories. The first 3 provide guidance on the quality of information. In other words, these principles identify characteristics of accounting information that make it useful. The last 3 principles give guidance for the measurement of information, how you calculate, and when you report accounting information. In the next topic, you learn about the relationship of these 6 principles to the actual accounting rules.
As you learned, there are 6 accounting principles, but there are hundreds of accounting rules. The accounting principles form the basis for the individual rules. Let's look at this relationship more closely by looking at a more familiar principle. The principle, don't drive your car too fast. At one time, there were no speed limits. You could just drive as fast as your car could move. However, those who drove too fast often had an unfortunate result. They crashed. What's the principle? Don't drive your car too fast. But some people kept driving too fast and crashed. So the principle needed to be enforced as rules. Those rules are called speed limits. But there's more than one rule or speed limit. There are hundreds. There are speed limits for different streets, different states, different countries. You get the idea. Accounting principles work the same way. There's one principle, and it becomes the basis for hundreds of individual rules. Understanding the principles is vital to understanding the accounting rules. One more point, what happens if you don't follow the principle? If you're driving, you might get away with disregarding the principle, but you could crash. If you don't follow accounting principles, you could get away with it. But what if the boss makes a bad decision based on your accounting information? Or what if you're audited? Obviously, the consequences of not following accounting principles can be severe. Remember, accounting principles form the basis of all accounting rules. If you want to understand accounting, you must first understand the underlying accounting principles. In the rest of this chapter, you learn about the 6 basic accounting principles. You also see each principle demonstrated in QuickBooks.
The first principle helps ensure the quality of information. This is called the reporting principle. The reporting principle states that financial reports should show information relevant to a user. The key word is relevant. In other words, does the information relate to the issue at hand? The principle defines whether accounting information is relevant. First, the information must be timely. As a user of financial information, you need the information while it can influence your decisions. For instance, a sales report 5 years late does not influence your decisions as much as a sales report from last month. Second, the information must have predictive value. This means that the information must help predict future results. For instance, a sales report by customer for last year can help you predict sales by customer for this year. Third, accounting information must have feedback value. In other words, it must allow the user to evaluate past decisions based on the information. Let's suppose that last year you decided to make an effort to get new business. A sales report for this year does give you information about whether that decision was good or bad. In the next topic, you use these 3 criteria to determine if 2 financial reports are relevant. In this topic, we begin working in QuickBooks. First, let's look at a profit and loss statement. Choose Reports, Company and Financial, Profit and Loss Standard. Click the Dates drop-down arrow and select this fiscal year to date. This report shows how your business did over a certain period of time. You learned about this report earlier. Is this report relevant? Let's find out. The first criterion of relevancy: is it timely? The report shows information for this fiscal year to date, so it is timely. The second criterion: does this report have predictive value? These balances represent the information for the first part of the year. Although the next quarter will be different, these numbers are generally indicative of your company's expectations. So the report does have predictive value. The third criterion: does it have feedback value? Let's scroll down to look at the bottom line. Net income. Bildum has made $15,906.01 this year. You predicted profit of about $15,000 a quarter, and this report substantiates this, which means the report does have feedback value. The profit and loss statement meets the third criteria, so it is relevant. Let's look at one more report. Choose Reports, Customers and Receivables, Open Invoices. Run the report for a previous year, and press Tab. Evaluate this report for relevance using the 3 criteria. The first criterion: is it timely? The report shows information that is more than 2 years old, so it is not timely. The second criterion: does this report have predictive value? This report would do a much better job of predicting the future if it included current information. The third criterion: does the report have feedback value? This report had much more feedback value 2 years ago. This report is not timely and has very little feedback and predictive value. Therefore, this report is not relevant. The second principle also helps ensure the quality of information: the reliability principle. The reliability principle states that you can have faith and confidence in accounting information. The numbers are reliable. The key word is reliable. How do you know when accounting information is reliable? The principle defines whether information is reliable. First, the information must be valid. In other words, the information measures what it's supposed to measure. For example, a sales report that shows purchases, not sales, is not valid. Second, the information must be verifiable. This means that more than one person can test the accounting information and get the same accurate results. For example, you could verify the total sales on a monthly sales report by adding each invoice's sales. If more than one person could do this, the information is verifiable. The third identifier for reliability is the information must be neutral. The accounting data cannot have any built-in bias which affects decisions made on the information. In the next topic, you learn how to evaluate whether accounting information is reliable based on these 3 criteria. A customer tells your boss that they might place a large order in a few months. Your boss decides to record an invoice in QuickBooks for the possible future sale. First, click the Create Invoices icon on the home page. Click the Customer Job drop-down arrow and select the name of the customer, Sun Valley Builders. The customer said they might place the order in 6 months. However, your boss enters the date as March 31st, so the sale appears in last month's financial statements. Click on the first line below Item. Click the drop-down arrow and select Double Install. The customer did not give an exact quantity. They said the purchase might involve many installations. Your boss decides that many is 100. Press Tab. The total of this invoice is $129,500. Before recording this invoice, let's evaluate whether this accounting information is reliable. The first criterion: is it valid? Does it measure what it's supposed to measure? Your company may never install 100 double doors for this customer. Therefore, this invoice is not valid. The second criterion: is it verifiable? Typically, there should be some documentation supporting the invoice. For this invoice, there is no documentation because there was no transaction. This invoice is not verifiable. The third criterion: is it neutral? Is there any built-in bias that affects decisions based on the information? You learn later that your boss receives a bonus if net income exceeds a certain amount during March. This specific invoice means your boss receives a big bonus for last month. So, this invoice is not neutral. The invoice did not meet any of the criteria for reliability. Hopefully, your boss clicks the Clear button before recording this invoice. Let's review the third principle. This principle deals with the quality of information. This is the comparability principle. This principle states two things. 1. Accounting information must be comparable between companies. Here's an example. Let's assume that Company A, located in Dallas, Texas, shows financial statements in U.S. dollars. Company B, located in Fort Worth, Texas, shows their financial statements in English pounds. You would have a very difficult time comparing these company sales because $1 does not equal £1. The comparability principle states one more thing. Accounting information must be comparable between accounting periods. For example, there are certain accounting rules which provide choices, like how you depreciate assets. In 1 year, a company uses a depreciation method called straight line. The next year, they use the depreciation method named double declining balance. Because they changed their depreciation method, their financial reports are not consistent from 1 year to the next. This lessens the user's ability to base decisions on the information. In the next topic, you see an example of the comparability principle. Let's evaluate whether an accounting change meets the criteria of the comparability principle. Click the Reports menu and select Company and Financial, Profit and Loss Standard. Click the Dates drop-down list and select this fiscal year to date. The boss asks you to start entering transactions in Russian rubles. Future reports will show Russian rubles instead of dollars. When you ask why, your boss says it will make things look much better. Let's evaluate this accounting change against the comparability principle. Will this report be comparable to the financial statements of other companies? The answer is no. Companies based in the U.S. present their financial statements in U.S. dollars, not rubles. The second criterion: will the company's financial information be consistent between accounting periods? Next year's balances will be in rubles, making the information inconsistent between accounting periods. Your boss's request to use Russian rubles is not in accordance with the comparability principle. The first three principles dealt with the quality of information. Now you learn principles that define how you measure accounting information and when you report that information. The first is the cost principle. The cost principle states that cost is the appropriate basis for recording transactions. In other words, what you give up, the cost, equals what you receive. Let's demonstrate this. Your company just purchased a brand new computer. What you give up, the cost, is $1,000. You record the computer at the cost of $1,000. Another important point is market value. When you purchase the computer for $1,000, its market value equals what you paid, the $1,000. What if the market value changes? How does this affect the value on the books? For example, 3 months later, someone releases a new super-duper computer that is twice the speed of your computer, and apparently twice the size as well. Here's the accounting issue. You could go to the computer store and purchase your model of computer for $250. So which number should appear in the accounting records? The actual dollars paid for the computer, $1,000, or the current market value or replacement value, $250. Here's what the cost principle specifies. Even if the market value changes, use the original cost in the accounting records. In the next topic, you see a demonstration of the cost principle. Your company decided to purchase a new machine for the factory. Let's write a check to record the transaction. Click the Write Checks icon. Click the Payee drop-down arrow and select Sliding Doors, Inc. The total purchase price of the equipment is $50,000. Here's a problem. This check is just for the down payment of $10,000. The seller is financing the rest of the purchase price. So, enter the amount you are paying, $10,000. Enter a memo. New Shine-O-Matic assembler, $50,000. Enter the line items for the check. Click the Account drop-down arrow and select Factory Equipment. Here's another problem. Although the total purchase price of the equipment is $50,000, this check is just for the down payment of $10,000. What value do you put on the books? The $10,000 down payment or the total purchase price, including the amount financed? The cost principle provides guidance. What you give up, the cost, equals what you receive. For the Shine-O-Matic assembler, you are giving up $10,000 with this check. Additionally, the vendor is financing the remaining purchase price of $40,000. You promise to pay that amount over the next 5 years with interest. So the total you are giving up for the equipment is $50,000. Now enter the loan on the next line. Click the Account drop-down arrow and select Equipment Loan. Enter the amount of the loan as negative $40,000. This is accurate from an accounting perspective. Click Save and Close. Remember, cost is the appropriate basis for recording transactions. The second principle that specifies how to measure accounting information is the revenue principle. The revenue principle answers 3 questions. What is revenue? How do you measure revenue? And when do you record revenue? Let's look at these 3 questions more closely. First, what is revenue? Revenue is the cash inflows to your company. Revenue is cash coming into the company, not cash going out. These cash inflows have occurred or will occur. In other words, you either have the cash now or will get the cash. Revenue is the result of the company's ongoing operations. This means revenue relates to your business's primary revenue-generating activities. A tax refund would not be revenue because that's not your company's primary revenue-generating activity. The next question, how do you measure revenue? You measure revenue based on the net value of the cash received. For example, you just sold several crates of product to a customer. The customer paid you $20,000 on delivery and owes another $20,000 in 60 days. The total revenue from this sale is $40,000, the total value of the cash received and to be received. The last question answered by the revenue principle, when do you record revenue? When an exchange has occurred, or the earning process is complete. Let's look at an example. Your company sells Shine-O-Matics around the world. A customer places an order today for shipment next month. Here's the question: do you record the revenue this month or next? Remember, you record revenue when the exchange has occurred. In this case, when you ship the product next month. In the next topic, you see an example of the revenue principle in QuickBooks. Bill to Make is expanding internationally, so the owner decides to borrow money from the bank to fund the expansion. Let's record this in QuickBooks. First, click Record Deposits on the home page. Let's enter the information on the first line. Click the Received From drop-down list and select Texas Bank. Let's enter the account later. Enter the memo, Loan to Fund Expansion. The check number is 123987. Click the Payment Method drop-down list and select Check. The amount is $100,000. Now let's enter the account for the transaction. Click the drop-down list to see your choices. Scroll down until you see the income accounts. Typically, money coming into the company is income. Does this deposit represent income to your company? The revenue principle defines 3 criteria to help answer this question. First, the transaction must be a cash inflow to the company. This amount is definitely a cash inflow. The second criterion, the cash inflow has already occurred or will occur. You now have check number 123987 in your hand. So the inflow has occurred. Third, the cash inflow must relate to your company's primary revenue-generating activities. Getting loans from the bank is not your company's primary source of revenue, so the account should not be an income account. Instead, select Bank Loan. This is a long-term liability account. Click Save and Close to record the deposit. Remember, the revenue principle defines 3 criteria that identify whether a transaction represents revenue. Let's review the third principle that deals with the measurement of information. This is called the matching principle. The matching principle makes 2 specific points. First, you determine revenue for any accounting period using the revenue principle. Second, expenses equal the costs required to generate that revenue. Let's look at an example. A customer places an order for a Shine-O-Matic for shipment next month. Following the revenue principle, you record the revenue when the exchange occurs, next month. You resell Shine-O-Matics, and you bought this Shine-O-Matic 3 months ago for $10,000. When do you show the $10,000 as an expense? When you purchase the Shine-O-Matic or when you sell it? Let's look at the matching principle for guidance. Remember, expenses equal the costs required to generate that revenue. So, if you record the revenue for the Shine-O-Matic next month, you record the related expenses in the same month. In essence, you are matching revenue and expenses. In the next topic, you see an example of the matching principle. Your company just finished its largest project in history. Let's prepare the customer invoice. First, click the Create Invoices icon. Click the Customer Job drop-down list and select the name of the customer, the Jones Group. Your company completed the project at the end of last month, so date the invoice March 31st. Click on the first line below Item. Click the drop-down list and select Double Install. The quantity is 100. Press Tab. The total of this invoice is $129,500. Click Save and Close to record the invoice. You hired an outside company for the labor on the project. Now let's write that company a check. Click the Write Checks icon. Click the Payee drop-down list and select Doorknob Corporation. Use today's date as the check date. You did receive the bill 1 week ago, but you are paying it today. The total cost of the labor is $70,000. Enter a memo. Labor for the Jones Group. Enter the line item for the check. Click the Account drop-down list and select Construction Labor. Click Save and Close to record the check. In the next topic, you see whether you matched the revenue and expenses for the project. You entered the invoice and check for the biggest project in your company's history. Let's review the results on the profit and loss statement. Click the Reports menu and select Company and Financial, Profit and Loss Standard. Click the Dates drop-down list and select this fiscal year to date. Click the Columns drop-down list and select Month. Click Collapse to hide the subaccounts. You learn more about collapsing financial statements later. Here's a big problem. The sale appears in March as this number, $129,500. But the cost appears in April as this number, $70,000. Scroll down to see how this affects overall profitability. For March, the report shows net income of more than $140,000. In April, there is a net loss of more than $70,000. The revenue and costs for the project are not matched in the same accounting period. How do you fix the problem? Let's review the guidance given by the matching principle. First, it states that you determine revenue by using the revenue principle. You started and finished the project in March. That means the earning process was complete, and you should record the sale in March. The $129,500 appears in the correct month. The matching principle also states that expenses should equal the costs required to generate that revenue. So, you should match the $70,000 labor to the related sale. Correct this by entering the labor as a bill and paying the bill on the appropriate date. Let's make this change. First, display the check by selecting Banking, Write Checks from the menu. Then click Previous 2 times. Here's the check. Let's delete this check and re-enter the transaction in the right way. Click the Edit menu and select Delete Check. QuickBooks warns that you are about to delete a transaction. Click OK. Close the check by clicking the X. The labor no longer appears in April. You actually received the bill from Doorknob Corporation 10 days ago. Let's enter the bill. Select Vendors, enter Bills from the menu. Click the Vendor drop-down list and select Doorknob Corporation. Remember, you received this bill about 10 days ago, so enter March 21st. The bill number is 222, and the amount due is $70,000. Let's enter the line item. Click the Account drop-down list and select Construction Labor. QuickBooks enters the amount for you. Click Save and Close to record the transaction. Let's see how this affects the profit and loss statement. Now the $70,000 for labor appears in the correct month, March. QuickBooks now matches the cost to the related revenue. This accomplishes the objective of the matching principle.